Chapter 12. The Mathematics of the Trade. History is rarely made by kings or generals alone. More often, it is made by clerks. In the dimly lit, wood-panelled chambers of 17th century Amsterdam and London, the modern global economy was being written into existence. It was written not with swords, but with goose-quill pens, iron gall ink, and towering stacks of bound paper. To understand the global impact of black pepper, one must look past the romance of the high seas and the thunder of naval cannons. One must look directly into the surviving financial records of the Dutch East India Company, VOC, and the English East India Company, EIC. These fragile, yellowing ledgers are the foundational datasets of modern capitalism. They represent the first time in human history that corporate entities attempted to mathematically manage a transcontinental supply chain. The directors of the VOC and EIC did not view pepper merely as a culinary luxury or a fragrant seasoning. To them, the wrinkled black spheres were units of pure financial data. Pepper was an asset class that could be leveraged, traded, and extracted to fuel the greatest accumulation of wealth the world had ever seen. For the modern supply chain data analysts, the surviving ledgers of the VOC and EIC offer a staggering revelation. These early companies operated massive, highly volatile data sets across oceans without the aid of telegraphs, computers, or even reliable maps. They managed fleets of wooden ships, tens of thousands of employees, and millions of pounds of silver bullion. Every single peppercorn that arrived in the ports of Europe was the final output of a brutal, highly calculated mathematical equation. The ledgers recorded the cost of canvas, the price of salted beef, the wages of doomed sailors, and the precise weight of silver. Beneath these mundane line items lay a terrifying reality. The historic spice trade was a high-stakes gamble where the ultimate variable was human life, and the ultimate prize was total market domination. The data of empire. The United East India Company, known universally by its Dutch acronym VOC, was established in 1602 through a government-directed consolidation of smaller pre-companies. The English East India Company preceded it by a mere 2 years, receiving its royal charter on the last day of the year 1600. Both entities were designed to solve a singular, pressing economic problem. The traditional overland spice routes controlled by Venetian and Arab merchants had been completely circumvented by the Portuguese. Portugal now held a fragile, highly lucrative monopoly on the maritime trade around the Cape of Good Hope. The Dutch and the English desperately wanted their share of this wealth. However, equipping a fleet to sail to the Indonesian archipelago was impossibly expensive for any single merchant or traditional partnership. The mathematical risks of shipwreck, piracy, and disease were simply too high to bear alone. To mitigate this immense risk, the companies pioneered revolutionary financial instruments. They introduced permanent capital, transferable shares, and the strict separation of ownership from management. They effectively invented the joint stock corporation as a tool for distributing risk. By selling shares to the general public, these companies pooled vast financial resources to mathematically offset the staggering dangers of the journey. The Amsterdam Stock Exchange was established shortly after the VOC's founding, essentially created to facilitate the trading of these corporate shares. This transformed the Dutch Republic into a financial colossus almost overnight. The raw mathematics of the early successful voyages defied belief and ignited a speculative frenzy. When the Dutch commander Jacob van Neck returned from the Spice Islands in 1599 with a fleet heavily laden with pepper, the expedition yielded an astonishing 400% profit. These massive returns proved unequivocally that the risk of the sea was worth taking. The 400% profit margin became a legendary benchmark that fueled relentless investment in both Amsterdam and London. However, systematically extracting these profits required meticulous, obsessive bookkeeping. The VOC chambers maintained sprawling financial archives to track their expanding operations. They utilized daybooks to log daily transactions, journals to arrange them chronologically, and a great ledger to formalize the accounts into specific categories of expenditure. Every iron nail, every barrel of beer, and every musket ball was rigidly accounted for. These ledgers reveal that the massive profit margins were not simply lucky windfalls. They were carefully engineered outcomes designed to offset the astronomical overhead of intercontinental maritime operations. Operating an East India Company was akin to running a private, heavily armed government. The companies possessed quasi-governmental powers, allowing them to wage war, mint their own coins, build fortresses, and execute convicts. The mathematics of a typical 17th century voyage represented a delicate balancing act of capital expenditure versus projected returns. The corporate ledgers explicitly broke down the staggering costs required to execute this massive logistical undertaking versus the ultimate payoff. The cost of ships. Massive cargo vessels, such as the efficient Dutch Vloot, had to be constructed, heavily rigged, and constantly repaired to withstand multiple brutal ocean crossings. The cost of the crew. Hundreds of sailors and soldiers required massive caloric provisioning, including heavily taxed beer, salted meat, and hardtack bread for voyages lasting many months. The cost of silver bullion. Because Asian markets had virtually no demand for European manufactured goods, the companies had to load their ships with vast quantities of silver pieces of 8 to physically purchase the pepper. The cost of military overhead. Maintaining the spice monopoly required heavy, constant investments in bronze cannons, coastal fortifications, naval warships, and standing armies stationed in Batavia and India. The gross revenue of returned pepper. The final sale of the imported spices at the Amsterdam auctions had to cover all preceding operating costs, absorb the losses of sunken ships, and still generate a substantial dividend for the anxious shareholders. Accounting for the dead. Within these immaculate ledgers lies a darker truth about the mathematics of the trade. The literal cost of human life was actively calculated into the corporate balance sheets. Mortality rates on these early voyages were horrifying, often exceeding the casualties of a major battlefield. It was mathematically common for a ship to lose half of its crew to scurvy, dysentery, or violence before ever returning to European shores. Yet, the companies did not record these tragic deaths as catastrophic financial losses. In the cold, unyielding calculus of the VOC and EIC, a dead sailor was often a direct financial benefit to the bottom line. When a crew member was hired, he was granted a small advance on his wages to purchase gear, but the bulk of his pay was strictly withheld until the completion of the voyage. If a sailor died at sea, his wages ceased accumulating on the exact date of his death. The ship's bookkeeper meticulously recorded these dates of expiration in the ship's logs to ensure the company did not overpay. While the VOC allowed for a legal document permitting wives or heirs to collect a portion of the earned wages, many men died without local heirs, or their paperwork was lost. In these frequent instances, the unpaid wages simply reverted to the company's coffers as retained capital. The high mortality rate effectively reduced the payroll overhead for the return voyage, increasing the net profit of the expedition. The ledgers treated human bodies as disposable, depreciating assets. The men were viewed merely as biological fuel for the corporate engine, entirely secondary to the precious pepper they died to transport. Furthermore, the companies actively calculated operational risk using early forms of financial derivatives and hedging. In 1613, the VOC faced a severe liquidity crisis. They had incredibly valuable ships at sea, but lacked the immediate cash to pay impatient shareholders their expected dividends. To secure their continuity, the VOC directors engineered a highly unique insurance contract. They effectively ensured the incoming cash flow from the return cargoes, guaranteeing a minimum revenue floor to their creditors. This sophisticated risk management technique proved that the company valued the mathematical predictability of its data above all else. They were learning to mathematically smooth out the volatile, unpredictable spikes of the ocean trade. The English EIC would later adopt similar, repeated debt hedging strategies to protect its own fragile balance sheets from the perils of the sea. The geography of arbitrage. At the very center of this massive corporate machinery was a simple, elegant economic concept, arbitrage. In the context of the 17th century spice trade, historical arbitrage must be understood as a geographical price gap. It is the practice of buying an asset in a market where it is cheap and simultaneously selling it in a market where it is highly expensive. In the dense, tropical environments of Indonesia and the Malabar coast of India, pepper grew in wild abundance. To the local farmers and regional merchants, it was a valuable cash crop, but its sheer, overwhelming volume kept local prices relatively stable and low. In Europe, however, pepper was a heavily desired, almost mythological luxury. It was desperately needed to preserve meats for the winter, flavor monotonous diets, and signal immense social status among the elite. Because the overland supply was highly restricted by Middle Eastern and Venetian intermediaries, demand in Europe wildly outpaced the available supply. This severe imbalance created a massive geographical price gap. The VOC and EIC were formed specifically and explicitly to exploit this gap. The corporate architects realized that if they could bypass the intermediaries and directly connect the point of abundant supply with the point of desperate demand, they could capture the entire margin of the arbitrage. However, exploiting a geographical price gap requires moving massive physical weight across the earth. Pepper is heavy, bulky, and susceptible to rot. It requires dry storage, constant protection from rats, and fierce defense against heavily armed privateers. The route Cholels, the Kretic and Stessonicrodes there, the E-weight is irregularly. The raw was staggering in their complexity. The European companies quickly discovered another painful mathematical reality of this arbitrage. The sophisticated Asian markets did not want European wool, iron, or glass. The only commodity they consistently accepted in exchange for their high-value pepper was precious metal. Thus, executing the arbitrage required a complex, multi-legged global supply chain. The companies had to first procure massive quantities of silver from Spanish-American mines. They shipped this silver bullion across the Atlantic to the counting houses of London and Amsterdam. They then loaded the silver onto heavily armed East Indiamen ships, sailed them around the southern tip of Africa, and exchanged the silver for pepper in the vibrant markets of Banten, Surat, and Malacca. Finally, they sailed the pepper back to Europe to be sold for even more gold and silver, starting the relentless cycle anew. The blind data delay. Executing this global arbitrage introduced a logistical nightmare that modern supply chain analysts can scarcely comprehend. The VOC and EIC were attempting to manage highly volatile commodity markets while suffering from a massive, debilitating communication lag. In the 1600s, this lag manifested as a total blind data delay. A heavy cargo ship departing London or Amsterdam for the Indian Ocean took roughly a year to arrive at its destination. It took another full year for the ship to return with its hold full of spices. Therefore, any market data, price reports, or executive orders sent from the corporate headquarters were at least 2 years out of date by the time a response could be received. Imagine attempting to run a multinational corporation where a simple query to a branch office takes 24 months to answer. The directors in Amsterdam, the famous Lord 17, would dispatch a fleet with strict written instructions on how much pepper to buy and at what maximum price. But by the time the fleet finally arrived in Java, the local geopolitical landscape had often completely transformed. Perhaps a local war had broken out, devastating the pepper harvest and restricting supply. Perhaps a rival Portuguese or English fleet had already purchased the entire seasonal yield, driving local prices through the roof. The captains and merchants on the ground had to make split-second, multi-million-dollar purchasing decisions using corporate data that was fundamentally obsolete. This blind data delay threatened to utterly destroy the entire concept of the arbitrage. If a fleet purchased pepper at highly inflated prices in Asia, and then arrived back in Europe precisely when the market there was saturated, the entire expedition would result in a catastrophic financial loss. The geographic price gap was constantly shifting like tectonic plates, and the companies were entirely blind to its movements while their capital was locked away at sea. The directors in Europe could only guess at the state of their investments. They watched the horizon for returning sales, knowing that a single severe storm could wipe out a year of projected revenue. The entire corporate structure was essentially an exercise in highly educated guessing, buffered only by the massive volume of their operations. The ocean-going accountant. To manage this immense logistical and financial challenge, the companies relied on a highly specialized class of employee. They could not entrust the complex mathematics of the trade to rough-hewn ship captains or illiterate sailors. They needed brilliant financial experts deployed directly on the ground. They needed the indispensable supercargo. A supercargo was essentially an ocean-going accountant. While the ship's captain was solely responsible for the safe navigation and physical security of the vessel, the supercargo was the supreme authority regarding the cargo, the cash, and the corporate ledgers. He was the physical walking embodiment of the company's balance sheet, tasked with managing the arbitrage in real time. These men were required to possess a remarkably rare combination of skills. They had to be highly educated in advanced mathematics, double-entry bookkeeping, and currency conversion. They had to possess incorruptible honesty, as they were entrusted with chests full of silver bullion thousands of miles away from any corporate oversight. Furthermore, they had to be masterful, quick-thinking diplomats. Upon dropping anchor in a foreign port, the supercargo would immediately disembark to negotiate with local rulers, garrison commanders, and wealthy Asian merchants. In the early 17th century, English supercargoes often had to conduct these high-stakes negotiations using Portuguese pidgin, the prevailing lingua franca of the Asian coastal trade. They had to navigate incredibly complex cultural protocols just to secure the right to purchase goods. The supercargo had to constantly calculate the rapidly shifting variables of the trade. He had to meticulously assess the touch or purity of the silver he was trading to ensure he was not being cheated. He had to weigh the local currency against the strict European standard mandated by his employers. He had to personally inspect the quality of the pepper, ensuring it had not been deceitfully adulterated with dirt, twigs, or moisture by local middlemen. Most importantly, the supercargo had to decide exactly when to buy and when to hold his capital. He had to leverage his limited, localized information to predict the future state of the European market 2 years hence. If he suspected that rival ships were also loading heavy cargoes of pepper, he had to calculate whether the European market could absorb the incoming supply without completely crashing the price. The entire financial success of the 2-year voyage rested squarely on the mathematical intuition of the supercargo. Historical records showed that these men were acutely aware of their heavy, almost unbearable responsibilities. They kept meticulous daily journals, recording weather patterns, the treacherous behavior of local brokers, and the exact prices paid for every single sack of spices. Through their fastidious record-keeping, the supercargoes provided the raw historical data that allowed the VOC and EIC to continually refine their macroeconomic strategies. The physics of monopolies.
As the 17th century progressed, the VOC and EIC evolved from fragile, experimental merchant ventures into towering corporate empires. Historians have deeply analyzed the statistical evolution of these companies, revealing how their trading systems matured into highly structured, ruthless bureaucratic machines. The companies eventually realized that the greatest threat to their sacred profit margins was not the treacherous sea, but each other.
Competition is the absolute enemy of arbitrage. When multiple buyers arrive in a market, they inevitably bid up the purchase price of the goods. When multiple sellers arrive in a market, they inevitably drive down the ultimate sale price. In this scenario, the geographical price gap rapidly collapses, taking the profit margins down with it. To protect their margins, the companies embrace the brutal, unforgiving logic of the monopoly. They utilize their quasi-governmental powers to wage continuous war against their European rivals and resistant local populations. The Dutch were particularly aggressive under the ruthless leadership of Governor-General Jan Pieterszoon Cohen. They seized the port city of Jakarta in 1619, renaming it Batavia, and established it as their heavily fortified Asian headquarters. The VOC violently ejected the Portuguese from the Spice Islands and fought multiple bloody naval wars against the English. They systematically forced local Indonesian rulers into exclusive contracts, demanding that all pepper and fine spices be sold only to the Dutch. If locals dared to trade with the English or the Spanish, the VOC responded with devastating military force, burning villages, destroying unapproved crops, and massacring populations. The EIC, though initially weaker and less capitalized than the Dutch, gradually built its own fortified factories in vital Indian locations like Surat and Madras. They created highly organized, intricate networks of local factors to source goods deep within the interior. Both companies effectively militarized the global supply chain, turning trade into a form of continuous warfare. This militarization required massive, unprecedented capital expenditure. The cost of maintaining stone forts, fleets of warships, and standing armies became a permanent, heavy anchor on the corporate balance sheets. To mathematically justify these immense fixed costs, the companies had to extract and import ever-increasing volumes of spices. They were trapped in a terrifying cycle of perpetual expansion. They had to flood Europe with pepper just to pay for the armies that secured the pepper in the first place. The Great Pepper Glut. By the late 17th century, this relentless corporate drive for efficiency and expansion triggered a catastrophic macroeconomic event. The corporate monopolies had become entirely too successful at their core task. They had optimized the extraction of black pepper to such a dizzying degree that they broke the fundamental laws of supply and demand. The result was a massive, historic supply glut. In economic terms, a supply glut is a flooded market. It occurs when the sheer physical volume of a commodity vastly exceeds the consumer demand for it, rendering the commodity nearly worthless. Pepper was still considered a luxury, but the European appetite was fundamentally inelastic. A wealthy merchant or a nobleman could only consume so many peppercorns on his beef or in his stews. No matter how cheap the spice became, consumers would not suddenly buy 10 times as much of it. There is a strict biological limit to the human consumption of seasoning. In the 1670s and 1680s, the VOC and EIC engaged in a fierce, mutually destructive price war. The English company, desperately seeking to break the suffocating Dutch dominance, began flooding the London and Amsterdam markets with massive shipments of pepper sourced from their Indian factories. The Dutch, possessing vastly larger financial reserves, aggressively retaliated. The VOC intentionally oversupplied the market to depress prices even further, utilizing a strategy of economic attrition. They hoped to starve the EIC of cash, drive the English into bankruptcy, and secure a total global monopoly once and for all. This corporate game of chicken resulted in a spectacular, unprecedented market crash. The financial ledgers from this era paint a grim, terrifying picture for the investors. In Amsterdam, the wholesale price of pepper had hovered healthily around 1.89 guilders per kilogram in the early 1600s. But as the supply glut deepened and the warehouses overflowed, the price began a steep terminal slide. By the 1680s, the price of pepper had crashed to a dismal 0.4 guilders per kilogram. The lucrative geographical price gap had almost completely vanished. The great mathematical engine of the spice trade stalled and sputtered. The legendary profit margins that had once routinely exceeded 400% were utterly destroyed by the sheer volume of the imported spice. While fine spices like nutmeg and cloves remained somewhat profitable due to stricter, more violent Dutch control in the Banda Islands, pepper was practically worthless. The high-volume backbone of the entire Asian trade was now barely covering the cost of its own ocean freight. The crash of 1683. The destruction of the pepper margins sent violent shockwaves through the financial capitals of Europe. The EIC, lacking the deep cash reserves and government subsidies of their Dutch rivals, was pushed to the absolute brink of ruin. The cost of their military overhead and their massive shipping fleets remained stubbornly fixed, but their primary source of revenue had entirely evaporated. In 1683, the English East India Company nearly went completely bankrupt. The financial panic was palpable in the coffee houses and counting rooms of London. The company's share price, which had been a highly reliable source of wealth for the English elite, plummeted from a lofty high of 600 down to a terrifying 250. The company's powerful president, Josiah Child, was temporarily forced from his office as furious investors revolted against the losses. The VOC survived the crash, but they too were bleeding capital at an unsustainable rate. Their long-term strategy of market manipulation had deeply wounded their own profitability. The 17th century pepper crash proved a vital, enduring economic theory. It proved that a monopoly cannot mathematically force a market to consume more of a product than it physically desires. The supercargoes returning from Asia found the massive warehouses in London and Amsterdam overflowing with unsold, rapidly depreciating pepper. The companies were mathematically paralyzed by their own success. They could not stop sending heavily armed ships to Asia, because doing so would mean abandoning their expensive forts and surrendering the hard-won territory to eager rivals. But they could no longer rely on the black spice to pay the bills. The massive, undeniable data sets contained in the corporate ledgers demanded an immediate structural change. If they continued to rely on pepper, both the VOC and the EIC would inevitably collapse under the crushing weight of their own military overhead. They desperately needed a new arbitrage. They needed new commodities with high consumer demand, high profit margins, and highly elastic consumption patterns. The mathematical pivot, faced with existential financial ruin, the corporate giants executed one of the most significant supply chain pivots in global economic history. The data analysts of the 17th century, the directors poring over ledgers and the supercargoes writing in their journals, began scouring the Asian markets for alternative goods. They found their glorious salvation in printed textiles and warm, caffeinated beverages. Starting in the 1680s, the ledgers reflect a massive, highly deliberate shift in cargo composition. The companies mathematically pivoted away from the doomed pepper trade and toward Indian cotton, Chinese tea, and Arabian coffee. This pivot was not driven by culinary preference, but by the cold, hard dictates of the balance sheet. Textiles offered a mathematically perfect solution. The skilled weavers of the Coromandel Coast and Bengal produced brilliantly colored calicos, chintzes, and fine silks that absolutely captivated European buyers. Unlike pepper, fashion was highly elastic. Consumers would eagerly buy multiple dresses, shirts, and tapestries as styles changed. Furthermore, the EIC discovered they could trade Indian cotton directly for Indonesian spices, entirely bypassing the painful need to export precious European silver. Simultaneously, the companies catalyzed a revolutionary change in European tastes by aggressively importing tea and coffee. Tea had been introduced early in the century as a bitter, highly expensive medicinal curio. But by the late 1600s, heavily promoted by the companies, it was rapidly becoming a daily social ritual. Because tea and coffee were mildly addictive and consumed daily, the European demand for them was virtually limitless. The historical statistics capture this dramatic transformation perfectly. Around 1670, pepper accounted for roughly 29% of the total value of the goods the VOC sold in Amsterdam. By the middle of the following century, pepper made up a mere 11% of their massive trade volume. The spice that had built the empire was now an afterthought. In stark contrast, textiles surged from 24% to nearly 30% of the cargo value. Most shockingly, tea and coffee, which had accounted for almost 0% of the trade in the mid-17th century, exploded to represent a whopping 25% of the VOC's total sales. The English EIC mirrored this mathematical pivot perfectly. By the 18th century, Indian cotton textiles made up 70 to 80% of their total imports, fundamentally altering the British economy. Leveraging the new world, the transition from pepper to textiles and tea did more than just save the corporate balance sheets, it actively reshaped the global economy. By leveraging their established supply chains to move new commodities, the VOC and EIC accidentally birthed the modern consumer culture. They proved that demand could be manufactured and scaled if the logistics were properly managed. The supercargoes had to learn entirely new skill sets. They had to learn to appraise the tight weave of Bengali silk, the delicate dye of a Coromandel calico, and the precise aroma of Canton tea leaves, just as they had once evaluated the pungency of Sumatran pepper. The physical ships were redesigned and modified to carry lighter, bulkier chests of tea rather than dense, heavy sacks of rotting spice. The entire physical infrastructure of the East India companies was systematically reprogrammed by the unyielding data of the ledger. The forts that were originally built to guard pepper warehouses now guarded vast textile operations. The silver that once flowed exclusively into the Spice Islands was now diverted into China to feed the insatiable European hunger for tea. This massive pivot also offset the terrifying financial vulnerabilities exposed by the pepper crash. Because textiles, tea, and coffee were sourced from entirely different regions, India, China, and Arabia, the companies effectively diversified their geographical risk. If a war disrupted the textile weavers in Bengal, the company could still rely on the massive profit margins of Chinese tea. The concept of corporate diversification was written in real time across the pages of the Great Ledgers. The mathematics of the trade had evolved from a simple single commodity arbitrage into a highly complex multivariable global matrix. The companies were no longer just extracting a naturally occurring spice, they were actively managing global consumer trends. They were dictating fashion in London, altering drinking habits in Amsterdam, and reorganizing entire labor markets in India and China to meet their highly calculated quotas. The legacy of the ledgers. The devastating pepper glut of the late 17th century forced the earliest multinational corporations to evolve or die. They ceased being mere spice merchants and transformed into colossal purveyors of global consumer goods. The rigid mathematics of the trade dictated that survival required massive diversification, and the companies obliged with terrifying efficiency. Today, the surviving ledgers of the VOC and EIC stand as monumental, tangible records of early global capitalism. They document the painful birth of corporate risk management, the sheer terror of the 2-year communication lag, and the brutal calculus of valuing human life against cargo space. They are testaments to an era when corporations first learned to read the world as a dataset. More than anything, these faded pages tell the story of a simple agricultural commodity that changed the geometry of the world. Black pepper built the vast fleets, funded the stone forts, and enriched the shareholders of Europe's golden age. It established the very concept of the global supply chain. But ultimately, the companies became so exceptionally efficient at extracting it that they broke the market itself. The crash of the pepper trade did not end global commerce. Rather, it forced it to fiercely innovate. The math of the ledgers demanded a solution, giving birth to the interconnected, consumer-driven economy we instantly recognize today. The scent of spice faded from the counting houses, replaced by the aroma of tea, but the cold, calculating logic of the ledger remained forever.